Hello and welcome to a brand new series. Union Mutual Fund presents Union Prabodh in partnership with ET Now. It's a very special series. The idea behind this is quite simple. Now you, me, we've all learned how to earn money, but very often, or rather rarely, has anyone taught us how to manage that hard-earned money. And with that very aim, this is an initiative that we've brought together. It's a very special investor education and awareness program. On this special episode, we have 4 participants who we will try and guide. And to guide them, I have 2 experts with me. First, allow me to introduce my experts. We have Hardik Bora. He's a fund manager with Union Mutual Fund. Hi Hardik, thank you so much for coming on the show.
Thank you.
And we have Gajendra Kothari. He's the MD at Ethica Wealth Management. Hi Gajendra, thanks so much for coming.
Thank you.
I have 4 very special guests with me. They are all teachers. Some are teaching at schools and some are teaching at colleges. And today we're going to try and guide them so that they can manage their personal finances in a better way. So let's go over to our teachers. Hi Shujat, thanks for coming on the show.
Hi.
Tell us a little bit about yourself and what's your question for our experts.
My name is Shujat Ali and I'm an educator by profession. And since 6 years I have been teaching, and I started with taking tuitions and freelancing, was a visiting faculty for many coaching centers, and then I wanted to settle down to a particular school, and where I got an opportunity to work with Budar International School. My question to the financial experts is very basic, that what if, let's say that you have a job running and for 4 or 5 years you have got a good job and you have all your finances settled, all your lifestyle is going smooth. What if that someday my employer tells me that you're fired, you're terminated? Then what happens? Then what is next? Apart from mutual funds or SIPs, what should I get into?
Gajendra, if you want to start with that.
No, I think very true, Shujat. Normally, like, we work hard for money, but is our money working hard for us? So right now, and we as normal human beings, we live through good times and we live through bad times as well. And that is where our savings comes handy for that rainy day, right? So if you are able to save when the times are good, and if it becomes a decent corpus, when we see a situation where we don't have jobs and we don't have money coming in, this becomes your passive income and helps you support to live that life. Mm-hmm. So we have few investors we saw, who were working with Jet Airways, and when there was this crisis, this savings came to their rescue. So I would really request you, because you are a salaried employee right now, every month try and save some percentage of your income, maybe 20%, 25%, whatever comfortable level, and put into a different form of savings. It could be very conservative, like fixed deposits or recurring deposits if you are a very conservative investor, or if it could be in the form of SIPs into mutual funds if you want little more high returns. Based on your risk profile and your time horizon, you should save. And you brought out a very important thing, that if I don't have a job, so that is why we request the money should be in emergency fund. Mm-hmm. 12 months of your expenses should at all point of time be in an emergency fund.
Right.
So that for next money, if you don't have a job, you don't have to be worried. So start with that, and then we can discuss on other goals over a period of time.
Super, fantastic. Let's move on. Dhara, tell us a little bit about yourself and your question for our expert.
I'm Mrs. Dhara Kapadia. I am a teacher at G.D. Somani Memorial School. I have been in the teaching profession since the past 18 years. My husband and I both are working professionals. We have 2 teenage children. And my question to the financial advisor is whether I should invest my income into tax saving schemes like the PPF and NPS, etc., where I pay little or no tax at the moment, or rather should I go in for high return investments where I pay tax but I also get a high return.
So Ms. Dhara, brilliant question. So I would suggest tax component should be one of the factors deciding your investment. It is not the end of all. The investment first has to be decided based on what profile you are. Are you a conservative person, aggressive person? What is your goal and what is your time frame? These are the most important questions. Based on these 3 questions, you choose what product fits the bill. Okay, so as you said, you're a conservative person, So then, your PPF or fixed deposits are the right investments. Within these investments, like PPF gives you tax benefit also. So you should choose PPF over a normal FD or other things. Just because other investments gives you high returns, you should not be, kind of going after them. We've seen people ending up choosing wrong investments because they were greedy for returns. So always try to understand yourself as an investor. Okay, see, investing is not it's not a race. Here we don't have to come first or second.
Yeah.
The end point of investing is to achieve our goals and peacefully. So that's very important. So you should, even if you're trying other investments, try with small amounts, and then as and when you get more comfortable, you can increase your exposure.
Super. Hardik, just wanted to get you in on your thoughts on this.
So I think Gajendra has already summed it up very well, and he's spoken about the ability to take risk, and you should only be able to take risk on so much that you can. But one thing that I want to maybe add over here, even taking into account what Sujat highlighted, is the willingness to take risk. See, yes, all jobs are definitely at risk at some point. That will definitely be the case. Sure. But for someone who is a teacher, their income that they generate is already fixed income like. It's stable relatively. It's not like a salesperson who has incentive based income. So to that extent, if your regular income is fixed income like, you might want to look at equity as a offset. So of course, depending on what your really ability is. But my point is that there might be a mindset that we don't want to take excessive risk because our income also is not of excessive risk, but that's not the case. You're supposed to supplement the risk also. So that's the only point that I might want to add apart from what Gajendra has already highlighted.
Fantastic. So we will get into this point in more detail soon, because I do want to, what you said, the importance of investing in equity, but how do I get into equity? So I'll come back to you on that in a bit. But Sujata, bringing you in on the conversation, tell us a little bit about yourself and your question for our experts.
I am Mrs. Sujata Zalkikar Gudi. I have been working in BPM's RZ Shah College, Mulund from last 13 years. And I am teaching accountancy and taxation subject in the college. All salaried people are worried about their investment, and everybody wants good returns with proper tax planning in less period of time. So we have heard that mutual fund is a very good source of investment, but how to invest in mutual fund is a big question, because mutual funds are subject to market risk. So how to get maximum returns and how to invest in mutual fund, that is the question.
Keeping in mind the tax as analysis. So see, there is definitely always this willingness to want to save tax, right? So yes, to that extent, there are different options available. But the other important aspect of our saving also should be wealth creation, right? And actually tax basically, you have tax saving schemes also in the equities, in the mutual fund industry, which can be used. But don't just be slowly focused on that particular aspect, because yes, there are many other aspects, other options available to you to save tax, but the wealth creation part, which basically will be played through mutual fund, will not be available in many other options. So keep that also in the back of your mind. As far as the mutual fund is subject to market risk argument is concerned, look, there is volatility and your NAVs will go up and down, unlike in other aspects. But the remedy to volatility is time. If you expand your time horizon enough beyond 3 years, that should take care of the volatility that you see in your capital, and over a longer period of time, equities historically have given good returns. So that's the perspective. If you would keep a shorter horizon, then the risk might be real for you.
Okay, great. Gajendra, your thoughts?
So, Ms. Sujata. So, I believe mutual funds is like swimming, learning swimming. You can never learn swimming unless you jump into the pool, right? So one cannot become a good investor by investing paper money, on online or whatever. You have to really be into it. So that is the first thing. Secondly, mutual fund is not another asset class. Normally people, when I ask them, where have you invested the money? This is, I have invested my money in equity, gold, FD and mutual funds. Mutual fund is a vehicle to invest in any of these asset classes. Right. It's not an asset class by itself. Through mutual funds, you can invest in fixed deposits kind of schemes. Through mutual funds, you can put your money into gold, into equity, into currency, and etc. etc. So it's a vehicle. Now, which vehicle to ride on depends on your requirement and your risk appetite. If you are a person who wants 6%, 7% return and you want safe returns, then you can choose the funds which are safer in nature, like liquid funds, which invest your money for shorter term and you can expect 7 to 8% return. If you are a person who want high returns, 12, 13, 14%, then there are equity funds, like which Hardik manages. So they are for longer duration and there you will see volatility. Like we saw in last week, markets going up and down. So if you are not comfortable, then don't go with these funds. Ideally, for a first time investor, we say start with conservative funds, over a period of time, educate yourself, and then start taking step by step and go into a little more aggressive funds. That's the best way to do. On day one, if you start investing into equity funds or sector funds with high risk, high return, and if you have unpleasant experience, then you will never come back to this.
Very true, very true.
So in the swimming pool, we go with 3 foot, 4 foot, and then we go to 7, 8, 10 feet. That's exactly how you have to embrace investing.
Vallabh, so tell us a little bit about yourself and your question for Ix.
Hi, my name is Vallabh Narayanan and I am in the teaching profession for last 8 years. I work at Mulund College of Commerce and my core area of expertise includes economics. My question to the finance experts is that, say if I am a beginner as far as investments are concerned, so how do I basically select between investing a lump sum amount and investing in SIP, and how do I pick the schemes?
Hardik, you want to take that?
So I will take at least the SIP versus the lump sum part. So see, both have actually different objectives also from an investor's saving perspective. See, SIP basically makes you more disciplined. It makes you into the habit of saving every month. And what also it helps is taking care of the volatility. So what happens is you keep participating in the market at different levels, when it is expensive, when it is cheap, and that way you kind of average out your purchasing price. So one objective of SIP actually is to make you more disciplined, and lump sum of course is a different ball game. I mean, that is to understand at what point you feel the market is attractive. For someone who is a beginner, an SIP makes more sense. But I think that's where the second question actually gets linked. For these questions, actually, you should take advice from someone, because they can be costly, deciding between one or the other. So
I'll come to Gajendra for that part, because it's a very valid question, because everybody says that, because everybody wants the best scheme. I want to invest in the best scheme, I want to invest in the best stock, help me pick that. So how do you guide someone in that case?
So Vallabh, very apt question. In fact, Sumit, there is nothing called best scheme in the world. There is nothing called best stock, because if you would have known this, I don't think we would have to be a part of this show, right? We would have been sitting in Bahamas and making a lot of money.
Yeah, for sure.
So just to add what Hardik said on SIP versus this thing, since you all are salaried, you're working as teachers, you're getting a regular income, so why not do regular savings? You have regular expenses, so regular savings should help, plan for your future expenses as well. That is where SIP is the best way, and it inculcates discipline in you. Now, if I'm a business person, I may not have regular income like you, right? Some months are good, some months are not as good. For me, in that case, lump sum may be a better way to invest, because I can't commit myself to a fixed sum. So that is the first part. In the long term, lump sum or SIP really doesn't matter, because it's both the ways of investing. That is the first thing. Secondly, which funds to choose? Okay, so there are quantitative factors wherein you can choose the past track record of the fund. You can go to various websites and see it, but that is only one part of the story. The other part of the story you need to understand is how long this fund has been. In good cycle, how is the fund manager performed? In bad cycle, how is it performed? So if you are only seeing last 1, 2, 3 years when it was only one way up the street, then you'll get a different picture. But if you see complete picture, you might find a different story altogether. That is fun. That is one thing. Secondly, sometimes what happens, Sumit, the fund manager has given very high returns, but he may have taken very high risk also in the process.
Right.
Okay, and this time you may be lucky it has played out. Not every time it will play out. Right. So that is also important. Third important thing, which is the qualitative factor, is the style of fund manager. Okay, now all these things, only when you interact with them and only when you see their portfolio over a period of time, you will come to know. And that is where, as I said, it's very difficult to do it yourself as a side profession. That is when you should be really consulting your advisor, ask him these questions, and he or she would be able to explain in a much better way, and you evolve over a period of time. Right. So these are not easy answers, but this is where your experience over 10-15 years help you.
Sujat, you had another question.
Yeah, actually I was just trying to figure it out and self-reflect when you said 12 months money to be reserved, to be kept with you, so that if there is a breakdown, there could be some possibility of safety. But as a layman, as a small investor, when I see that I need to put some money every month in my account, but keeping this in mind that there are banks shutting down, institutions coming down, and there's always a risk factor there.
Yeah.
So do you suggest me to also keep some amount for gold or some property, because I can see that physically as a human being? I want to see something with me,
The
because that could
intangible
actually
versus
keep me
tangible,
safe,
right.
content, okay, that my money is with me.
Right.
But when something is in bank,
Yeah.
I might land up to a dicey situation. It's like
I
that.
think
Very,
Gajendra
very
first
valid
and then
question.
Hardik,
Very
yeah.
valid question. So, if it is in context to your emergency fund, parking money in property may not be a good idea because you won't be able to realize it when you need it. But yes, gold, is something which you can pull it out whenever you want. But what we tell people, so gold again can give you negative returns. Okay, if you think that gold is safe, gold can also give us negative returns. So the best way to park your idle money for the emergency fund is park in a liquid asset or liquid funds. So you can keep it in a bank FD, but if you're worried that what if your bank goes bust tomorrow, then the other option is liquid funds in a mutual fund, where what happens, your fund manager invest this money, or rather park this money into 20 different good banks or good companies. So it's like AAA, best of the class kind of thing.
So allocation.
Yeah,
So when you're putting your money in 20, when the fund manager on your behalf putting in 20 companies, of course one company can still go bankrupt tomorrow, but then only 5% of your exposure has gone. Unlike your 100% FD has gone and logged into a bank. So that is where mutual fund is a great vehicle for diversification purpose.
Right, Hardik?
So I would just stress on the diversification bit, right? I mean, in this current scare also with Yes Bank's issue, what happened? Yes, so the old adage is that don't keep all your eggs in one basket, right? So if you can even spread out your emergency fund, as Gajendra highlighted, that is basically the only antidote you have to some of these black swan events that nobody can really capture, but they actually turn up. So that's the only answer that I can give to this.
Sujat, Vallabh, any more questions? Okay.
So
Yes.
when we invest money, the first target is I want maximum return with of course less period of time, period of time. And the most important thing is tax saving on returns also. So which source you would like to suggest in this case?
Yeah. So there's no investment in the world called maximum returns and lowest risk. First of all, it doesn't exist. So any investment which gives you high returns will carry high risk. One should be really get this clear. That's the first thing. Secondly, as I said, tax saving should be only one part of the investment. It should not be the factor deciding whether I should go for this or not. I know many people, they are sitting on huge gains on houses. Okay, they bought the property 20 years ago and now sitting with huge gains. They don't want to sell property because the tax component is very high. They're forgetting that they made huge returns on the property, right? So that should not be a component. And look, one thing we all should know and understand: tax changes every year. You can't, change your investments every year based on the taxation.
Right, because and you can't even predict what the tax is going to change.
Predict,
it's unknown.
So always first go with the merit of the investment, whether it is suitable to you or not, to your risk profile, to your goals. Then tax is only one of the element. If it helps you in getting more returns, then why not?
Fantastic.
The only thing that I'll add to that is, now as far as return optimization goes, right, the way you can work is what is the risk-free rate of return in our country, right? So you work with that. That is the optimum return you can make without taking any risk as such, right? And then as you ask for higher return, you will have to take higher risk. So that's how the relationship between risk and return works. For that higher risk that you take, it will either manifest in the volatility of your capital, or it will take shape in the form of illiquidity, that you might not be able to withdraw it. So these are things that will happen. So you have to see for yourself that what kind of risk you can take, because risk is good, because risk brings you that return. But you have to see what kind of risk you want to take, and then you have to optimize for what risk, what return you are getting.
Fantastic. Well, we're just about out of time, but just last, Gajendra, first to you and then Hardik to you, just last piece of word of advice to them and to the viewers.
No, my only piece of advice is that, we have to make our money work smarter for us. While you may want to relax on Saturdays and Sundays, your money should be working for you 24/7. So that is, the sooner we know, the sooner we understand this, the better we'll be able to live a good quality life.
Fantastic. Hardik?
So in today's age, there is excess information and advice available. My suggestion to you would be, if you're starting out, take an expert advice and start. It's better to not make too many mistakes in the beginning of your investment journey.
Learn from someone else's experience. Thank you Gajendra for coming on board. Thank you Hardik, thank you Sujat, thank you Dhara,
so
thank you
much for
Sujata,
inviting
and
me.
thank you Vallabh, and thank you so much for watching. You were watching Union Mutual Fund presents Union Prabodh in partnership with ET Now. It's been a very interesting investor awareness and education program, and we hope we've been able to help you and guide you so that you can also secure your financial future. Thank you so much for watching.
So the key takeaway was that usually we feel that teachers and academicians are so busy in the academic world, they may not have time to go through their personal finances. Their salary may be just lying in the bank accounts. But I think in this day and age, we find that a lot of these people have started taking interest, and today they are aware of the options which are existing to them. So they just need little more guiding, and by attending few of these programs over a period of time and doing some more homework, I think they'll be able to manage their money much better. The only advice which I would like to give it to them is that since they're earning every month, they should make that savings habit also part of their routine life.
It was a good way to connect with some of the investors and kind of give them advice. For a mutual fund manager, usually it is done through an advisor. I would say again, start early. It is important to start this journey as soon as you can, and do it in a disciplined way, like through SIPs. Your income is already like a fixed income sort of in nature, so it's better if you could actually add more equity spice to it.
Today's session has been very enriching because it was more of a self-reflection for me, that to take a firm decision on investing, because being a youngster and being into this field, also having a fixed income, it was very important for me to understand that investing is important because you never know what can happen in future.
Key takeaway is I got to learn more about mutual funds, investment in mutual funds, and basically the difference between investing a lump sum corpus and investing through SIPs, their advantages, disadvantages. I also got to learn how to pick schemes and assess the risk factors. Overall saying, it was very informative, and I got to learn many new things from different people and from the experts as well.
It was a very enriching experience for me, and I learned from the experts that tax saving is not the only criteria that you should be looking at. You should evaluate your risks based on your profiles and priorities. That is my takeaway point.
Today I came to know about the various areas or fields of mutual funds, tax saving plans, as well as the perfect and correct debt equity ratio, debt equity proportion. That will definitely help me in taking investment decisions in future.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.